Welcome to Commercial Real Estate Now in partnership with CBRE Debt and Structured Finance and my co-host Farhan Kabani. I'm Carly Iacono. Farhan, fantastic to see you again. How are you?
Hey, great to see you. Happy New Year.
Happy New Year. We are kicking off 2025 with a informative and timely episode covering the different types of lenders in the market, where they're most active, and what we're expecting for 2025. It's a lot to cover. So happy you're here to walk us through this today because I know this is valuable information as everyone on the investor side continues to navigate what is still a somewhat challenging financing market. So thanks for being here and let's kick it off. You
I'm
ready?
excited. Yes, ma'am. Let's go.
All right. Let's start with the most obvious. I think the first lender that most people think of when they think of financing commercial real estate, and that is bank financing. Talk to me about the structures you see, where they're most active. Give me the lay of the land on bank financing.
Definitely. And this is kind of your most traditional avenue for capital, right? The primary focus really for banks, whether they're national, regional, local, larger money center banks, all the way down to the small community bank, the objective really is to be the primary source of capital flow into the economy. So that said, you're utilizing banks for construction lending, for interim and mini perm products, as well as for permanent solutions, but generally, 5 to 10 years or less in terms of duration. With on a floating rate product or a construction loan, which would be floating, you might have a 3 to 5 year duration, 3 years on the construction piece, and maybe a mini perm thereafter. But on a permanent solution, you may have 3, 5, or 10 year fixed products, generally with 25 to, I'll call it from 20 to 30 year amortization schedules, and maybe an interest only period uh, before stabilization. The loan sizes really vary. For our group, we generally will deal with 1 million or greater in terms of loan amounts. But within the banking industry, there are different step ups in terms of deal sizes. There are certain banks that have funding capacity up to say 15 million. Then the next step up in terms of if they have a larger asset base, they might be able to fund up to 25 million or 50 million. In each instance, you'll see, in many cases at least, you'll see some sense of hedging, which is syndicating those loans or partnering on those loans. So you'll see banks partnering with one another if the deal size gets large enough. As well, you'll see some selling in the secondary market.
So really, we
Where
have
that's
a pretty broad. Let me stop here just a second. We get a pretty broad
sure.
range of deal size. Talk to me about any unique things in the deal structures. What does prepayment typically look like on these? And you mentioned 3, 5, and 7, or 3, 5, and 10. Is it 3, 5, 7, and 10? What are the options on term?
Yeah, so it ranges from, call
Okay,
it 3 to 10
3
year
to 10.
term, right?
Got it.
And because there's some flexibility there, and many times there are renewals built into that. Thereafter, some banks will offer up extensions, but generally within 10 years. I will say that, asset classes, you're able to utilize banks for every asset class. Um, in
Prepayment.
terms of prepayment penalties,
Yep.
there's more flexibility, right? Many of the banks are servicing their own loans. They may have a shorter duration. They may offer up some sort of open period after, say, 2 or 3 years. Some may offer no prepayment penalty in the event of sale. So there's really like flexibility there. But usually you're seeing some sort of step down, maybe a 1% for 3 years, or 5, 4, 3, 2, 1, or some other percentage amount for the term of that loan.
And as we go through these basics for our listeners, note that for everyone listening, we're starting off very straightforward, right? To
Yeah,
lay the groundwork. Here are the basic terms for these. I think we have like 7 or 8 different lender types, right? There's a lot more complexities here, and this may be something we pick up on a later episode. But this is meant to be a foundational episode to introduce investors to perhaps a world beyond just bank lending that they didn't know was there, and kind of lay the groundwork for different options. So know there's more to it, which we likely will cover at a future episode as well. But I think this is important baseline information.
Absolutely. And within each category, there are tons of intricacies that we could get into,
Right.
but then we'll be sitting here all day. So we'll keep it short and cover the topic and maybe have a follow-up session.
Sounds great. So give us a little glimmer or thought on what you're expecting from banks in 25. We've seen some concern, in the last 2 years because of potential office product defaults. How's liquidity? Are they lending again? What does the landscape look like for bank lending appetite?
Great question. I would say, liquidity wise, they're at a moderate level and improving as a whole.
Okay.
We did see a significant pickup in terms of bank activity in the fourth quarter, in terms of bank lending activity. And for perspective, banks make up maybe almost half of the overall lending capacity
It's a
in the
lot.
marketplace or market share in a given year. However, in the last year, they made up about 30% market share. So there's a pretty significant drop off. However, that fourth quarter was strong, and there's a lot of momentum expectations, and liquidity seems to be stabilizing.
And are you finding bank appetite for all different asset classes? I know they each have kind of their buckets that they like to focus on, but are you seeing really liquidity and equity for every type of asset? What's been the landscape there?
Yeah, you're usually looking at your major food groups. You have your multifamily, retail, industrial, office, not so much, but there are solutions. Thankfully, there are so many banks in the marketplace. They're at every corner in many cases. So there many times is a bank solution for every problem, or call it for every deal.
Right.
Uh, it's just a function of those that may be more competitive in a certain asset class than another, or obviously considering some of the other buckets of capital available.
Before we move on to the next lender, I think everyone's first question is, where are rates and spreads going to be? So this is a tough one, given the volatility we've seen every day. It feels like it's a different day with a 10-year. But where do you think, and we're not holding you to specific rates, but where do you see banks lending right now? And what's your guess on where that might go?
Sure. So historically, spreads for banks, vary by asset class, location, region, and they can vary pretty significantly. But to give you a general idea of range of spreads that one may expect uh, over a specific or index, um, 175 to 225 over, or 175 to 250 over is a general range, and banks generally price over U.S. Treasuries, swaps, or FHLB, the Federal Home Loan Bank, uh, depending upon their charter, for that matter. But all in rate wise, it ranges from, call it, low sixes to upper sixes in today's marketplace. Um, you know, I would say there are some instances where you'll see rates over 7% as well. Um, Again, it ranges dramatically by asset class and location, but that's, a general sense.
Are you seeing spreads widen based on perceived risk in an asset, or has that always been, the case that higher risk, larger spread? Are you seeing that gap increase, or is it held pretty consistent?
So the gap does increase obviously by asset class. It's a great question.
Right.
However, what we have started to see as well is some spread compression across the board. Not necessarily the variance between the risky asset versus a less risky asset, but more so just as a whole. We're seeing in each of the buckets some spread compression. So that's all good news. That
I was
means
going to say
the
that's
risk
music to
levels
my ears.
improving. Yeah,
Yeah,
absolutely.
exactly. Good. All right. Well, that was positive. Let's move on to credit unions. I feel like that kind of overlaps with banks in terms of types of deals they'll look at and structures. But tell me the basics on credit unions and perhaps how they're different from banks.
Sure. They are similar to banks in terms of that category. And many times they are categorized the same way. When you think of credit unions, think of a co-op in terms of the memberships. And then there is a difference between state chartered credit unions and federally chartered credit unions, in terms of the asset classes or coverage markets that a specific credit union may be able to cover. But usually there's similar profile for loans that are under $50 million as it relates to banks. The maybe the unique outlier there could be that their rates sometimes are more competitive. They're also pricing, you know considering spreads over treasuries, or and other indexes for that matter. But many times credit unions we consider to be rate sheet lenders, call it. So they may price adjust depending upon the marketplace every few weeks rather than fluidly on a daily basis. So sometimes that results in slightly competitive pricing as compared to some of the other buckets. Usually, most credit unions offer 30-year amortizations, so you generally get that longer amortization period. And another benefit is no prepayment penalty, at least for the federally chartered credit unions cannot charge a prepayment penalty. So that zero prepayment penalty offers a lot of flexibility, and a lot of clients of ours have actually gone that route in the last couple of years, especially considering elevated rates and expectations that maybe yields will come in, and then they could be in a better position to refinance without a penalty. So that's a benefit of credit unions. I will say, in terms of participations and syndications, I feel like you see credit union participations and syndications more frequently, and that's across the credit union spectrum, not just in specific or asset sizes or bank size tranches. It seems like even the largest credit union may participate with some of the smaller groups, or take participations for that matter. So it's a very open marketplace, and it has been fairly competitive, especially in the last 10 to 15 years.
So if the rates are competitive, sometimes even better, there's no prepayment penalty, and we can often get 30-year amortization. Why would anyone not go with a credit union versus a bank? We're just comparing these two. What are the downsides? It
Great
sounds
question.
fantastic, right?
Sometimes it's recourse. I would say most
Okay,
credit unions, require more recourse. There are
got
credit
it.
unions that will offer non-recourse, but it's again select situations. Another maybe just qualifying area. A credit union may not offer offer terms in a specific marketplace, so you might have to
Yeah.
defer to bank anyway.
So it may
Deal
not be an option,
and
is the
deal
downside.
size.
Right.
Yeah,
Okay.
I will say also, I will say for the most part, like credit unions seem to deal in the larger, call it the larger food groups or the primary food groups. If there's, if they're looking at asset classes outside of your typical product, whether it's a retail deal or even a net lease deal for that matter, if they're looking at an outdoor storage deal, they may be less inclined to offer up terms as compared to banks.
And you mentioned the syndication or partnership of credit unions behind the scenes. Are there any effects whatsoever to the borrower due to that structure, or is that just sort of like an interesting data point?
It's just a data point. It
Okay,
allows for higher funding capacity. I would say in
got
the
it.
past, you would think that credit unions, may not be able to cut a bigger check, but in recent markets, you're able to see, credit unions offer up bigger loan sizes, and that's because of those
These
syndication and
partnerships.
participations. Yep.
Yeah, interesting. And spreads, where are they coming in? You said sometimes they're a little more competitive than banks. What's the range look like there?
Their spreads generally are, call it 200 to 250 over, and that's just a very general range. So you'll see the starting point a little bit higher. However, like I mentioned, there many times those credit unions are pricing on rate sheets. So if there's a fluctuation in the marketplace, that's all-in spread may actually equate to something closer to 170. It just depends on on timing.
Got it.
So all-in rate-wise, like right now, if I'm just giving you a general range, it's very similar to bank, right? It's like mid upper sixes, maybe touching up to seven, but it's in line. But again, there are just different times in the marketplace wherein a credit union might not have adjusted their rates as swiftly as a bank.
Which is why it's so important to work with a team like yours. This is a an unasked for plug to get right to test these different lenders, because like you just said, one might be more competitive one month and another month based on all these other market factors and the time frames that they reset, et cetera. So you really
I'll
have to
take the
figure out where
plug.
everyone is.
I'll take the opportunity. I'll take the plug.
Yeah.
Thank you. But yeah, I mean that's essentially what we do. We're comparing the products available and
Right.
across the board. We're helping clients assess the overall situation and providing advisory across all these different lending categories. You need somebody to help you navigate. It's important to understand what you can get and what you can't get, and
Right.
someone that has considerable, or a team that has considerable experience in the marketplace can really help to drive the overall, the best available terms, but also provide advisory to meet your longer term goals.
Let's move on to a completely different category that I'm sure some of our private clients haven't interacted with yet. Maybe they have as they start to scale, and that's the life cos. What do those loan terms look like? What kind of deals are life companies offering, bidding on, let's say, or putting term sheets out on? There we go.
Yeah.
And how does that compare to the first two groups?
So generally, life companies are focused on the least amount of risk, but offering the longest duration products, right? Conceptually, if you think about it, these life insurance companies hold these long-term policies, right? And those dollars have to be reinvested in the marketplace. So one avenue for reinvestment is mortgages, commercial mortgages for that matter, but they're long duration. So, but all those have to be secure products. So generally, life companies will focus on multifamily, industrial, some retail, some office, historically at least office. Now it's somewhat limited, and also healthcare. But you're really looking at the call it the considered to be the safest overall investment strategies. And similarly, those products have to be rated. For a life company, many times they're focused on products that are rated CM1 or CM2 by the NAIC. So they're really looking at the top tier. What that results in is, focus on, say, an appropriate basis or very high asset quality, and also, focusing on sponsorship and business plan for that matter. But if you compare then to the shorter duration products offered by a bank, you may see a higher, more improved pricing with a life insurance company if the deal qualifies, of course. So spreads wise, you might see something in the range of 130 to 200, 220, call it over, depending upon the location of the asset and time in the marketplace. Uh, all in today rate wise, if you're looking at, say, an industrial asset, uh, say a multi-tenant industrial asset for that matter, that qualifies for that rating, that could price in the you know in that closer to 150 over, plus or minus, and that puts you in that like upper fives, upper fives, low
Nice.
sixes for that. It just depends obviously where treasuries are at, but upper fives, low sixes. So usually you're seeing long duration products, 10-year fixed, 15-year fixed plus. Nowadays you'll see some life companies try to balance out their portfolios and the maturity. So you might see an offering for 7 years or plus or minus, but generally speaking, they're longer duration products. But also deal size wise, it's relevant to consider that most life companies play in a larger space, over $20 million. Uh,
Right.
you
Talk
know,
to me about
there-
recourse. I'm assuming you can get non-recourse then with
yeah,
this
there's
level of asset,
non-recourse. Exactly.
right?
Their focus really on the asset, have more heavily on their asset. And I will say, don't. We also there are a select group of life insurance companies that play in that 2 to 20 space as well, uh, but the vast majority play in the larger space. But
Right.
generally, it's non-recourse. Various product offerings in terms of amortization schedules. You could have a longer amortization schedule, have interest only component, and that interest only component to it, but it really is, the focus then is really the basis of the real estate, from a lender standpoint, in which case those, the interest only may be offered, but it's likely offered at a lower leverage than what may be offered in one of the other buckets of capital.
Leverage was an interesting point we didn't bring up on the other two. I'm glad you just touched on that. So life insurance companies will offer lower leverage typically than credit unions and banks.
Generally,
I
when
thought
it's
it would have been the other
trust,
way around. Okay.
well, again, some of the offsets for banks and credit unions is recourse, right? In some
Right.
instances,
Right.
or
That's
also
the
just
security. Hmm.
overall portfolios in terms of other asset classes or even specific properties. I think companies are very targeted in their approach of the assets that they like on their on their books. So and similarly, the leverage has to really be appropriate. Don't get me wrong; there are situations where you'll see a life company offer 70% LTV plus, but it's also stressed where there has to be adequate cash flow to really prove that up. Um,
Right.
and it's all the timing in the marketplace. But generally speaking, you would see a life company offered product in like the 60 to 65% range, um, loan to cost wise, as compared to, what, maybe slightly higher leverage with banks and credit unions. And again, we're speaking
Of
generalities
course.
here.
And I think that's important for the listeners to keep in mind for every group that we talk about here, every lender type. These are generalities. It's just meant to give you an overview. But of course, there'll be nuances to each one, like we mentioned. So, last question on the life coast before we move on. How do you exit these loans? Is this defeasance? Is it yield maintenance? Is it prepayment? It sounds fantastic term wise. How do you get out?
Yeah. So, because of those long duration products and offering of those such competitive pricing, usually there's a yield maintenance tied to it. When considering what yield maintenance, how that's calculated, it's essentially at a given point in the market, you're paying off based on the present value of future cash flows to that lender. So it can be expensive on your prepayment penalties, especially for those longer duration products. Um, but again, many times that's offset with highly competitive pricing. And I will say the life companies were probably the most competitive, uh, most competitive in the last year, in the last 12 months. And they captured considerable market share, right even from the beginning of the year with fresh allocations. And similarly, we have fresh allocations and high expectations for, output this year.
I think that's one thing, though, for everyone to keep in mind. We see this a lot on the investment sales side. There is a cost, depending on which way the market's swinging, to yield maintenance. We'll often factor that into the calculation of is it a good time to sell or not, because that affects your proceeds at the end of the day. So it's something to consider. If you're not sure what the whole duration is, that could be a significant cost. Not to say the other terms don't outweigh that, but it's certainly not irrelevant.
Absolutely, and it's important to consider as well as considering any assumption availability in each of those buckets as well. And many times
Right.
there is assumption availability across the board.
Which was, like gold if the loan was from a few years ago when rates were
Yeah,
insanely low. Now, maybe not as exciting, right? But
absolutely,
assumption
agree.
provisions are fascinating when they work in your favor. It really can be a huge boost to the asset value. So, yeah, that's
But
a great
and a
point.
burden on the other side. Yeah, when rates
Yeah,
are
and a
really
burden on the other side. Yeah,
yeah.
exactly. Yeah. All right, let's move on to CMBS. This one I always feel like is a headline buster when you say it, right? And the media is like, oh, CMBS is like crashing financial markets, or it's like the latest amazing financial tool. To me, on the outside of what you do, it feels very polarizing. We've done some bigger net lease deals with CMBS financing. They're very complicated, but can be extremely attractive on the front end. So tell me what you think. What are the ins and outs of CMBS debt?
I mean, look, you kind of nailed it. It's boom or bust in some instances. You're getting the most, I'll call it the most competitive combination of options, offerings from a CMBS loan, and usually it's maximizing cash flow, the ability to maximize cash flow. So what CMBS is a mortgage-backed security, a security that's created by pulling a bunch of loans together by various investment banks, and then selling them and selling those bonds. Uh, separating them out into various tranches or bond classes and selling them in the secondary market. What that results in is you have, you know, availability or a lot of liquidity in that marketplace when it's flowing, and you can have competitive pricing, but you can have usually a 5 to 10 year duration product on an interest only basis at a moderate to high leverage point, non recourse. albeit there are heavier prepayment penalties in terms of defeasance or yield maintenance, but generally the pricing is more competitive, and or can be competitive when the market's thriving, which it is currently.
Right.
The last, like you mentioned, the polarizing news that comes out is whether CMBS is thriving or it's not, and it seems to be a bit volatile at times. I think this is a decent streak we've seen through 2024, where CMBS was performing really well. Output was huge in terms of dollars committed. I don't have the exact stat, but I want to say it was roughly 106 billion. Don't quote me on that, but I want to say
It's
that
a
output. I
lot.
mean, that's
Whatever it
pretty.
is,
That's dramatic. Yeah, it's
it's a lot.
significant.
Yeah.
Absolutely, and that's available liquidity for for these asset classes that may not have a home otherwise, with on an interest only basis. Also, we've seen some you know deal sizes well in excess of $100 million loan amounts, and in many cases when you get beyond that, you're also looking at these SASB deals that are must qualify for the asset class as well as for sponsorship, but you're it's a unique attribute in the marketplace, where seems to be a lot of capital available, and again, overall favorable terms, especially for those that are in desperate need of debt or refi for that matter.
What are the minimum deal sizes you see for CMBS?
You could do a CMBS deal in some groups will take on a small balance deal as low as, like call it $2 million, but it doesn't really start making sense. Economics don't start making sense until after, I'd say, $5 million on the loan
Okay.
size. And again, there's not really an upper limit. There are groups that will focus, they focus their books entirely on 10 million plus or 20 million plus. But there are some groups that'll get down to 5 million and change, usually wanting to be a very clean deal and easy in execution. The asset classes being multifamily, industrial, retail, and then but you can get hospitality deals done in that scenario. Some office deals, again, assuming it's they're stabilized and historically performing reasonably well. Self storage, as well as others. So there's well-rounded portfolios. CMBS performing well, and it's a great option for non-recourse interest only.
And it sounds like there could be slightly more risk in these deals than the life cos, right? CMBS could have maybe less credit than the life companies would require. I don't know. I'm just trying to compare the
Yeah,
two. Okay.
yeah, it's price adjusted. It's risk reward in some instances.
Right.
The higher the debt yield, the lower the pricing, skinnier the pricing. But the more risk, you have a risk adjusted return accordingly, and you might see 10 to 15 basis points added to the rate accordingly or more. Some hospitality deals might price at 325 over SOFR or UST, but the anchored retail deal may price at 200 or 225 over, depending upon the debt yield, that is. So you could see that variance priced into the specifics of the deal, and I will say the high level of sophistication and understanding of those asset classes and underwriting. So the pricing in many instances is justified. The harder part is many times you can't really rate lock into closing, so market adjustments can cause a deal to fall apart, potentially, or result in some significant additional capital contribution. But there's an execution strategy there in many instances, and it's a liquid product, at least in today's marketplace, that's readily available.
That had to be extra challenging the last few years when rates have been moving weekly, daily, right? If you cannot rate, you said this fast, but I think this is a huge point. You cannot rate lock until closing. So trying to execute on a deal that maybe takes 60 days plus, right, to get everything together and not knowing what your rate's going to be until the last day, that is very tricky. So I'm
Now,
sure.
I will say there are some hedging options for
Okay. There's got to be
index spread,
something. Right.
but it's highly expensive and it doesn't, you know, it's not there's not a guarantee that you're going to get that index and spread. You might get the index, you may not get the spread. So yeah, there's still some risk even with that hedging, even with the hedge in terms of CMBS.
Before we move on, do you have a specific type of deal, or if someone brought you a fabricated deal with whatever characteristics, what would that look like that would make you go, CMBS is where I'm going to start on this? Is there a type of deal that fits best?
So, for us, I will say we try to tackle multiple buckets of capital, not just focus just on entirely on one segment, but one, I will say one segment that could work or a deal example that might work for CMBS, but it might also overlap with other buckets. Let's just use an example of a retail deal, an anchored retail deal. You have grocery anchored retail. Um, so you have a grocery anchored retail deal, say the price is in excess of 20 million, 25 million. The let's say appropriate cap on the deal, say upper sixes on a cap scenario. I would say on a deal like that, CMBS could be a good execution if the client is, if it's investment capital and client is looking for, max proceeds with an interest only period, or full term IO, non-recourse. That could be a deal that I think would fall in that bucket.
Could be a good fit, but could also get interest from the other lender types, to your point.
Yes, it would. But pricing wise, if today, for using that same example, let's just say somebody did a 5-year IO deal today. Again, we're just using a hypothetical, and you have
Right.
appropriate population density, and yet all the other boxes checked in terms of lease roll and every which underwriting standard considered. But if you're at like call it 9 debt yield on a retail anchor retail deal, maybe that price is in the closer to 210, 220, possibly lower, but let's just use like a 210 scenario. Well, in that instance, your upper six is full term IO, non-recourse, and probably potentially closer to like, closer to 70% LTV potentially. Might have to run those numbers, but back of the envelope, I think that's kind of where it would price out. So that's a great option,
Right.
if somebody's really seeking to max out that cash flow.
And you mentioned IO 5 years, and then you said full term. What's the longest duration of interest only that you've seen?
10 years. So
Okay. That's a long.
CMBS historically has
Right.
been, historically has been 10-year duration product. That's what prices the best, similar
Got
to
it.
what you would see in a bond, right? Even T-bill. But there's been a marketplace created in the last, couple years, and it's been now there's a strong market for 5-year CMBS. The prices in terms of spread, it's a little bit wider than 10, but it's readily available. Historically, you would have to take a significant pricing premium to do a shorter duration product from a 10. But more recently, in the last couple of years, 5-year durations have become more common.
And just being able, like you said, to have that long duration of interest only that I really don't know you can get any other way to that level is such a boost to the cash flow. I mean, that's just a huge difference. So it really does come down to not only what is the asset type, but what are your goals during the whole period? Is it to pay down the debt? Is it to maximize cash flow? Do you want flexibility on selling? Are you going to hold it long term? Like all this plays in to these decisions. It's not just rate, of course, right?
Exactly. All these other factors to consider, and
Hmm.
um, it's important to take multiple considerations, not just your rate and term. It's to consider
Right.
who's servicing your loan, what's the period, what are my trigger events for defaults and reserves. I mean, there are a lot of different factors to consider, primarily to CMBS as compared to even other asset class or other lending classes. But
Hmm.
um, you know, that's what we're here to navigate.
Exactly. Let's move on to debt funds. Run me through the basics. What's the structure look like? When are they a good option? What do their terms look like?
Sure. So debt funds are generally made up of investment management firms, asset managers, and private equity. Uh, many of these debt funds are actually purchasers of CMBS. But think of names, like Apollo, Blackstone, Ares, Goldman, Bridge. Those are the groups that really play in that debt fund space, and there's been a considerable amount of capital that's been raised, in the last 5 years for output through debt funds, and in the last 12 months, I think this has been, probably the strongest year for debt funds. And their focus primarily, well, at least historically, has been bridge lending, right? They're a capital solution for deals coming out of CMBS, or maybe it's something that requires a value add component. So usually your structures are like 3+1+1, it's a 3-year fixed plus 1-year adjustments. Also, there's like 5-year products as well. But it's generally those debt funds can play in the entire capital stack, right? They'll provide mezzanine solutions, pref equity solutions. They're invested in, a lot of these groups are also invested in real estate, which also makes sense why they're buying CMBS product. So there's a very holistic approach from these debt funds, but a specific approach in terms of chasing down bridge product, whether bridge lending that is, and whether that's moderate yield or high yield.
It sounds like they're the problem solver of the mix, right? You have something that doesn't quite work, or you need a little extra something, or it's not fitting into these other buckets. They have creative solutions, although I'm sure at a price to make the deal whole. Am I looking at it right?
Yeah, you are, but also considering that some of the products are also they're shorter duration by virtue of interest rates,
design.
right? So design. So if rates are rates currently in the 7 to 8% range for a product, or call it even 8+%, but on an interest only basis, it might make sense to do that, to take that product as compared to a long-term fixed deal at 7% and have a heavy prevent penalty, right? It's like this doesn't just add, they're not just providing capital for value add solutions, they're also providing near-term fixes even for stabilized product, which ultimately can result in higher overall yield.
Flexibility and problem solving. There's a place for everyone. I love it.
Yeah.
And they certainly have a lot of smart people on their teams figuring out how to profit from, but also support the clients, through these different strategies. So it makes sense that they're a piece of the puzzle as well. Let's move on to private equity. This is something we hear, from all different verticals, right? Buying businesses, consolidation, buying real estate. What's private equity's role in financing real estate?
Sure. So think of private equity firms as a, call it, balance between debt funds and life companies. They're many times those private equity firms or those backers to the debt funds. They may be allocators for life insurance companies as well. So there's that results in unlimited availability of bridge capital through these private equity groups, as well as discretionary and non-discretionary capital in terms of allocations from life insurance companies for longer duration products, or even call it maybe shorter duration than what you typically see on a life company product, but more competitive in pricing. So if an allocator may offer up a 220 spread, or call it a 200 spread on a 5 to 7 year deal for a life company like execution, but if you went direct to a life company, in some instances you may see a 10 to 15-year offering only. So there's buckets of capital available for a competitive pricing, but on the flip also there's availability for or call it unlimited availability in terms of capital to the for bridge and other capital stack related solutions, right, throughout the spectrum, whether it's debt or equity.
And is that when you're typically reaching out to a private equity company as a bridge solution? Is that where you see them fitting in most frequently in your practice, or is there another scenario that is common?
We see them in both. So we'll see them in both in terms of the allocate. So we represent a considerable number of life insurance companies, but also those life companies are also allocating capital to various alternative investments, right? Some of those life companies may allocate to a PE firm that's investing on their behalf. So in those instances, if we have access to those firms as well, it just allows our clients to, see a potentially competitive solution that kind of falls between maybe CMBS and Lifeco in terms of pricing and execution to maybe a better suited, specifically for that goal. And then similarly, it's for bridge capital, it may be a cheaper solution versus a conventional debt fund like product. It's just another resource.
And what is the sort of rate? What is the asset type, deal size? What does that look like? Is there a range or is it highly variable?
It's highly variable. I would say starting point wise, you're similar to CMBS, where it starts, where it might make sense down to $5 million on a loan amount, but many groups won't play below 20 million. Some will play below 50 million. So it really depends on the specifics in those situations. Pricing wise, the focus I will say is, all kinds of asset classes, but your pricing is skinnier for the major food groups. So for multifamily, you could see, pricing get as skinny as call it like 200 over SOFR, or call it 225, call it over SOFR, whereas some of the other bridge options, or at least interim options, might be, starting point might be 300 over. So you see some pricing benefits in that instance if the deal qualifies.
Right. And if it fits their particular bucket.
Yeah, but there's also availability of capital for outlier asset classes, larger data centers. Again, there's unlimited availability of capital within that space. So, those larger data center deals, maybe they'll price wide. They're going to price wider than obviously a multifamily or typical industrial deal, but there's availability of capital there.
Interesting. Let's move to the opposite side of the spectrum, at least in my mind. We're going from private equity to agency lenders, your Fannie and Freddie. What does that market look like? We don't touch that at all in retail in my business, but so I have a very weak baseline on what these programs look like. So tell me what qualifies for Fannie and Freddie, what the rates look like, what the structure looks like.
Sure. I'll say it varies. There are specific criteria. There's specific markets where there are targets at given times. There's also, in some instances, affordability tests. There's a wide, variation of options within the space, but within the bounds of specific requirements, if that makes sense. So, Fannie Freddie, you immediately think of multifamily lending. There are specific Fannie and Freddie approved lenders in the marketplace. And if usually it's, more cost effective and maybe more flexible in terms of durations, or at least, additional capital funding if needed, and down the road. There's a lot of flexibility, but it's really catered specific to multifamily. And it's the ideal product in many cases, in most cases, it seems, for any large multifamily owner.
And is that if the asset qualifies or if the borrower qualifies? Like what is the benchmark versus just going to a traditional bank lender? Like how do you qualify?
Yeah, great question. Generally, your starting point is the asset, but I will say for sponsorship really does matter. So I have seen deals that you would think qualify for Fannie, but sponsorship doesn't. So it's a combination of the two. But basically think about it, once you're in, you're in, and you can grow. You can really scale a business, utilizing those funding vehicles. And pricing wise, also consider that your pricing is, it's still a government subsidized product. So you're still, your pricing is still inside of every other bucket of capital. So you could see pricing in the, low 100s, and then obviously touching up to 200, depending upon the specific criteria for that asset within multifamily, location wise, or quality of asset.
This is just a quick side tangent. Do you think that this was designed, or was it designed to increase affordable housing? Like, why is this a government subsidized program specifically targeting multifamily? Like, why
So
does this
yeah,
exist?
I mean
Okay,
that's
affordable housing.
the GSEs. Yeah, exactly. The
Okay,
affordable housing for
got it.
housing availability in general, shelter.
Right. Okay, makes sense. So if your asset fits, if the sponsor qualifies, this is going to be a fantastic option, basically across the board, most competitive.
Yep.
All right. Let's move on to SBA, another type of loan we don't touch in my
Yes.
space, but how do you get involved in that, and when does that make sense?
Yeah, it's a government program option for asset classes that you may see that we work in terms of the middle market or commercial middle market. Usually, you're seeing owner occupied properties. You may see a small to mid-sized industrial facility if it's owner occupied warehouse. You could see a hospitality finance that's been a significant SBA has played a significant role there. The Also for call it for gas stations, gas station operators for that matter. It's owner user across the board for SBA. There's 7A and there's 504, two different funding mechanisms. The benefits of using SBA is generally you're able to secure higher leverages, 80% to in some cases up to 90, but usually it's
Wow.
called like 80 to 85% LTV. And there are specific criteria that must qualify, but for the sake of this discussion, the criteria really is owner user as the owner occupied property, whether 51% or more of the property must be owner occupied.
And is that loan being backed by the business and the real estate, or just one or the other?
So technically both for in terms of the availability, it's business and real estate, especially if you think about it from a hotel standpoint, the hotel operation and the underlying real estate, but it would have to be the operator taking on that loan. It can't be a net lease hotel for that matter. It can't be somebody that's buying just the investment real estate piece they wouldn't qualify for an SBA loan.
Now, what if someone has an SBA loan and they do a sale leaseback and sell their real estate? Have you seen that happen? Would they then be disqualified? And we're getting kind of technical, but just curious if that would still hold or if they would be disqualified in that case.
I believe in most cases, if there's a real estate tied to that loan, it's not just purely for the operations.
Right.
Then they would have to likely pay off that SBA loan.
Refi.
But if it's bifurcated in some instance where you have the operations, the machinery, the personal property covered under an SBA loan, I don't believe that would have to require any sort of like payoff for a sale leaseback. But again, we don't have to dive too much into that on our end. On our day-to-day, we don't see it very often, but that's where I would see the potential where you wouldn't have to pay off.
It's definitely a talking point because we do advise owner users on sale leasebacks, and the financing structure that they have in place is a piece of it. So that's an interesting element.
For sure.
Okay, we've gone through a lot today. I know we have one more sort of all-encompassing bucket that we're going to try to lump everything else in, at least at a high level. So talk to me about all the alternative investment and alternative financing options like REITs and private lenders. What else is out there high level that you want to touch on?
Sure. I would say call it like the high yield or high hard money solutions, and that's generally like private non-bank lenders. It touches up against debt funds in some instances, but it's really just focused on high yield. The mortgage REITs, many times they're offering high yield solutions relative to call it high yield relative to a permanent solution. So it may not be extremely expensive, but it may have other attributes that are positive. They're also lenders that are in the marketplace made up of family offices, syndicated funds, peer-to-peer, and a lot of those are, will the components of those loans generally will vary, but many times they're moderate to higher yield products, bridge lending products, or even mezz and pref equity solutions. So really kind of investing throughout the capital stack, similar to what you would see with kind of the private equity funds or the debt funds for that matter.
I think one of the takeaways from today's episode, or at least I hope one of the takeaways, is the vast nature of the financing landscape, right? There are really solutions for all these different scenarios, types of assets, what you're looking for. And there's a lot of options out there. So I think it's definitely something to keep in mind. If you're newer to investing or you've owned a few assets and you've just gone with traditional financing, there might be other solutions out there that can solve problems as you grow in investing. And your team and others in that space are perfectly positioned to guide clients through all these many complexities.
Yep. So buy your deals from Carly and finance them through me.
Exactly. That is the conclusion. That is the punchline today. And sell through us, of course. Yeah. I think that was implied, but thank you for bringing it out. No, it's true though.
Sure.
It's a great market, and with all of the headlines of the challenges of financing the last few years, I'm not saying they're gone, but it's nice to hear that there's solutions for a lot of different scenarios and you're able to navigate it.
Awesome. Well, thank you so much for giving me the opportunity to speak. Absolutely.
To everyone listening, we are so grateful you tuned in. That was this week's episode of Commercial Real Estate Now, and we look forward to seeing you again very soon. Have a great day, everyone.